Welcome to my YouTube channel. If this is the first time of you coming across my lecture, if you are a returning subscriber, I say thank you for being part of this channel. So in today's lecture, I will be examining sales variances using question number 3 of ICAN November 2024 performance management as worked example. Sales variances. Sales variances or revenue variance. Total sales variance can be divided into two. Total sales variance can be divided into two. We have sales price variance, sales price variance, and sales volume variance. The sales volume variance will be divided into two. Sales mix variance and sales quantity variance. Quantity variance. So each of these will be examined one after the other. Remember, variance is the difference between standard and actual. Variance is the difference between standard and actual. Variance is standard minus actual. If you did plan to sell each of your items at 200 naira, you did plan to sell them for 200 naira each. This is your standard selling price. And at the end of the period, you might end up selling it for 250 naira. That means you have sold this item more than you planned, leading to a variance of 50 naira. Therefore, I've told you variance is standard. 200 naira is the standard minus actual. 250 naira is the actual selling price, while 200 naira is the standard selling price. There is a variance of 50 naira on a unit price, meaning that you did plan to sell one for 200 and you actually sold them for 250, leading to a variance of 50 naira. Therefore, by the time you sell 1,000 units of the item, 1,000 units, remember each unit has a variance of 50 naira. Therefore, 1,000 units now, we have a total variance of 50 naira times 1,000 naira, giving us 50,000 naira. So, meaning that you are having 50,000 naira as the total sales price variance. This variance, when you are analyzing your variance, you have to analyze that variance into either favorable or unfavorable. An unfavorable variance can equally be called an adverse variance. So, if you did plan to sell them for 200, you actually sold the item for 250. That means the items were sold higher than your initial target. That means more income is coming into you, more inflows of money, more inflows of cash. Therefore, this is giving rise to a favorable variance. That means this 50,000 is a favorable variance. Therefore, that is why we say sales price variance. Sales price variance, which is standard selling price minus actual selling price multiplied by actual quantity sold. Remember, your standard selling price based on my illustration is 200 naira. And the actual selling price is 250. Actual quantity sold is 1,000. 200 minus 250 giving us 50 naira. 50 naira times 1,000 giving us 50,000 naira. I said this is a favorable variance because you have more inflows of cash than you have planned. You are getting more cash than you did plan because you plan to sell them for 200. If these 200 were sold, it would have been 200 times 1,000, which is 200,000. If it were sold based on your initial estimate. But when these items were actually sold, you will have gotten the sum of 250,000. That is 250 times 1,000, which is 250,000. The 250,000 is more than the 200,000 you have planned as your estimated revenue. You know your estimated revenue was 200,000 naira, and your actual revenue is now 250,000, leading to a variance of 50,000 naira, being the difference between the 200,000, your estimated revenue, and the actual revenue of 250,000, giving us a variance of 50,000. I said it is favorable because you have gotten more than you've planned. So that is sales price variance. Therefore, sales price variance is the difference between standard selling price minus actual selling price multiplied by actual quantity sold. Multiplied by actual quantity sold. Actual quantity sold. If this is sales price variance, sales price variance, SPV, equal to standard selling price minus actual selling price multiplied by actual quantity sold. Quantity sold, actual quantity sold. That is the formula for calculating the sales price variance. Remember, the second variance is sales volume variance. When you are referring to volume, you are talking about the quantity. So we used to budget for the quantity to be sold. You might budget to sell 1,000. You may actually sell either higher or lower than 1,000. If you budget to sell 1,000 and you ended up selling 1,200, that means you are having a favorable variance, a favorable volume variance of 200. So when you are calculating the sales volume variance, you want to compare your budgeted quantity with your actual quantity sold. Number 2, sales volume variance. When you say volume, sales volume variance, that is, we are referring to the quantity sold. We don't have standard quantity sold. We don't use the word standard. If you have watched my earlier videos, I've told you standard is a unit cost concept, while budget is a total cost concept. The difference between budget and standard is the budget is total. It's for the overall quantity or units. While standard is for one unit, a unit that is standard. That is the difference between budget and standard. Both budget and standard, they are estimates. They are estimates. Neither of the two are actual. Standard is an estimate, but that estimate, that standard is used for a unit. While budget is also an estimate, it is used for total. Please take note of that. Therefore, sales volume variance equal to budgeted quantity. Budgeted quantity sold minus actual quantity sold multiplied by standard profit. If you are using absorption costing, you use standard profit. But if you are using marginal costing, you use standard contribution. Standard contribution. The two schools of thought are marginal costing and absorption costing. Therefore, sales volume variance, we say it is budgeted quantity minus actual quantity sold multiplied by standard profit or standard contribution. Please take note of that. I've told you, if the schools of thought is marginal costing, you use contribution. If it is absorption costing, you use profit. So if there are no fixed overheads that are absorbed to the product, you know that it is contribution alone. If the only variable costs are contribution, if the costs you are given are only variable costs, no information about fixed cost. So you know that it is only contribution you can calculate. In that case, it is standard contribution. But where there are information about fixed cost that can be absorbed into the product, then you use absorption costing. So that means it is standard profit that will be used. Please take note of that. That is sales volume variance. If you did plan to sell 1,000 units, this is your budgeted quantity. You are budgeted to sell 1,000 units. And at the end of the day, you actually sold, actual quantity sold. You actually sold 1,200 units. That means you have sold more than budgeted. What you budgeted for, you are able to sell more than you have budgeted for, leading to a quantity variance of 200 units. 200 units in your quantity variance. You now multiply it by the weight. I've told you the weight can be standard contribution or standard profit. Then if it is standard profit, let us assume the standard profit is standard profit. That is profit for a unit of the product. Let us assume it is 10 naira. Therefore, you have 10 times 200 giving us 2,000 naira. 2,000 naira. The variance is a favorable because you will get more revenue because you have been able to sell more than planned. Then you sell more than planned, then more revenue. In that case, 1,000, you have a favorable variance. That means you have a favorable variance of 2,000. How did we get that? We said budgeted quantity, which is 1,000 units. Budgeted quantity, 1,000 units, minus actual quantity sold, which is 1,200, multiplied by the standard profit or standard contribution, and we have standard profit of 10 naira, multiplied by 10 naira. So 1,000 minus 1,200, giving us 200. 200 times 10, then you have 2,000 naira. I said it is favorable because you are able to sell more than planned. That means you are getting more inflows, you are getting more cash than you have planned. This is a favorable variance. Then we said the sales volume variance can be divided into two: the sales mix variance and sales quantity variance. We said the sales volume variance, I said it can be divided into two. We have the sales mix and the sales quantity variance. Sales mix variance and sales quantity variance. Sales quantity variance. Sales mix and sales quantity variance. Sales mix variance indicates the effect of profit on changing the mix of actual sales from the standard mix. Sales mix variance indicates the effect on profit. The effect on profit of changing the mix of actual sales from the standard mix. I repeat, sales mix variance indicates the effect on profit of changing the mix of actual sales from the standard mix. So, sales mix variance. Sales mix variance. If you have watched my earlier video on mix variance, I said revise standard quantity minus actual quantity. So, this time, remember I've told you budget is used for sales. So, it will be revised budgeted quantity. Revised budgeted quantity sold minus actual quantity sold multiplied by standard profit or standard contribution. Remember, I've told you where it is marginal costing, school of thought, you use contribution, and where it is an absorption costing, you use profit. Your revised budgeted quantity is equal to actual quantity times actual mix times standard mix rather. standard mix. Actual quantity times standard mix. I will explain better by the time I'm taking question as work example. Then the second one is sales quantity variance. Sales quantity variance, which is yield variance for materials. If it is material, we talk about material mix and material yield. So this is mix, this is yield. So sales quantity variance. Sales quantity variance. If you have watched my earlier video on material yield variance, I said it is standard quantity based on actual production minus revised standard quantity multiplied by standard price. So since it is budget we are using now, so sales quantity variance, if it is standard quantity based on actual production, that would have been budgeted quantity. Budgeted quantity sold minus revised budgeted quantity. Revised budgeted quantity, which I say is actual quantity times standard mix. So the same thing you have calculated here. So you have it here. Multiply by standard profit or standard contribution. Standard contribution. ICAN November 2024. Performance management question number 3. ACCA and Sons Bakery Limited uses absorption costing technique in its accounting system. The company produces and sells 3 bakery products, namely four corner loaf, F, round corner loaf, R, and executive loaf, E, which are substitutes for each other. The following standard selling prices and cost data relate to these 3 products. We have product FRE. Selling price for F 200 naira, R 250 naira, E 300 naira. Direct material per unit 25 kg at 3 naira per kg. That is for F. R 30 kg at 3 naira per kg. E 38 kg at 3 naira per kg. Direct labor per unit 1.2 hours at 10 naira per hour for F. Then for R 1.5 hours at 10 naira per hour. While for E 1.8 hours at 10 naira per hour. Variable expenses per unit for F 1.2 hours at 5 naira per hour. For R 1.5 hours at 5 naira per hour. While for E 1.8 hours at 5 naira per hour. Annual budgeted fixed production overhead was 4,320,000 naira. The company policy is that overhead will be absorbed on a machine hour basis. The standard machine hours for each product and the monthly budgeted level of production and sales for each product are as follows. We have products F, R, and E. Then the standard machine hours per unit 0.3 hour for F, 0.6 for R, and 0.8 hour for E. Monthly budgeted production and sales in units 10,000 for F, 13,000 for R, 9,000 for E. Actual volumes and selling prices for the 3 products in a particular month are as follows. We have product F, R, and E. Actual selling price per unit in naira 220 for F, 260 for R, 360 for E. Actual production and sales in units 9,500 for F, 13,500 for R, and 8,500 for E. You are required to A. Calculate the following variances for overall sales for the particular month. 1. Sales price variance. 2. Sales volume variance. 3. Sales mix variance. 4. Sales quantity variance. B. Determine the monthly budgeted profit for the company. C. Discuss the significance of sales mix variance in the variance accounting system. Solution. The name of the entity is ACCA and Bakery Limited. ACCA and Sons Bakery Limited. ACCA and Sons Bakery Limited. The first requirement, you are required to calculate the following variances for overall sales for the particular month. The first requirement is to calculate the sales price variance. We want to calculate the sales price variance. 1. A1, sales price variance. Sales price variance. Sales price variance. Sales price variance equal to standard selling price minus actual selling price multiplied by actual quantity sold. Actual quantity sold. Sales price variance equal to standard selling price minus actual selling price multiplied by actual quantity sold. You have 3 products. Product F, product R, and product E. Then we need the standard selling price for each of the products and the actual selling price. The actual selling price per unit for F is 220, for R is 260, and that of E is 320. Minus 220, 260 naira, and 320 naira. That is the actual selling price. Then we still need the standard selling price multiplied by the actual quantity sold. The actual quantity sold for F is 9,500, for R is 13,500, while that of E is 8,500. So we have 9,500 units, then 13,500 units, then 8,500 units. Then we need the standard selling price here. The following standard selling prices and cost data relate to these 3 products. So these are the selling price. These are the standard selling price. For F, 200 naira. For R, 250 naira. And for E, 300. So we have F. Standard selling price is 200 naira. For R, we have 250 naira. And for E, we have 300 naira. Now, sales price variance, 200 minus 20, that will be 20. 20 times 9,500. That gives us 190,000 naira. 190,000 naira. It was sold more than planned. It was sold more than budgeted. So that means the amount it was sold is higher. So this is a favorable variance. Favorable. 250 minus 260, that will be 10. 10 times 13,500, that will be 135,000 naira. 135,000 naira. It was sold more than planned, therefore it is a favorable variance. Then 300 minus 320, that will be 20. 20 times 8,500, so we have 170,000 naira. 170,000 naira. It is also a favorable variance. 170,000 naira favorable. Now, let's sum up our favorable variances for the three products. 170,000 plus 135,000 plus 190,000. So we have 495,000 naira as the total. 495,000 naira favorable. 495,000 favorable. That is sales price variance. Sales price variance. We have a favorable variance of 495,000 naira. 2. Sales volume variance. Sales volume variance. So sales volume variance. I've told you we used to budget for the quantity we want to sell. So there is no standard quantity sold. So we always used to have budgeted quantity sold. So you have budgeted quantity minus actual quantity sold multiplied by. So I've told you where it is marginal costing school of thought that we normally use standard contribution. But for absorption costing, we normally use the standard profit. So we have multiplied by standard profit. Standard profit. So, but we need the standard profit since it is not given in this question. So now, let's calculate our standard profit. Calculation of standard profit. There are three products. Let's have a column for product E, a column for R, a column for F. So you start with standard selling price. Standard. The information to use here must be standard. So selling price, selling price. The standard selling price for F is 200 naira. That of E is 250. That of R is 250. That of E is 300. We have 200, 250, and 300. That is the standard selling price. Then you are given cost details, which include direct materials per unit. So you were told 25 kg at 3 naira per kg. Direct materials. So 25 kg at 3 naira per kg. That will be 25 times 3. 25 kg at 3 naira per kg. So 25 times 3, that gives us 75 naira. 75 naira. So that of R will be 30 times 3, which is 90 naira. That of E will be 38 times 3. That gives us 140 naira. 114. Then we also have direct labor per unit, which is 1.2 hours at 10 naira. Direct labor 1.2 hours at 10 naira per hour. That will be 12 naira. Then 1.5 at 10 naira, that will be 15 naira. Then 1.8 at 10 naira, that will be 18 naira. 18 naira. Variable expenses. Variable expenses. We have 1.2 at 5 naira per hour. 1.2 hours at 5 naira per hour. 1.2 times 5. That gives us 6 naira. Then we also have 1.5 at 5 naira. 1.5 times 5. That gives us 7.5. 7.5. Then we also have 1.8 at 5 naira. 1.8 times 5. That gives us 9 naira. Direct labor. Direct labor. Direct labor. We have 1.2 hours at 10 naira. 1.2 hours at 10 naira per hour. 1.2 times 10, that will be 12 naira. For R, 1.5 at 10 naira, that will be 15 naira. 15 naira. And for E, that will be 1.8 at 10 naira. 1.8 times 10, that will be 18 naira. Then, direct expenses. We have variable expenses. Variable expenses. Variable expenses. Variable expenses, that is 1.2 at 5 naira per hour. 1.2 hours at 5 naira per hour. 1.2 times 5. That will be 6 naira. Then 1.5 at 5 naira per hour. 1.5 times 5. That will be 7.5 per hour. Then 1.8 at 5 naira per hour. That is 9 naira. We have fixed overheads absorbed. Fixed overheads absorbed. For this purpose, we will need a fixed overheads absorption rate. Since we are given the total fixed overheads for the year, you were told annual budgeted fixed production overheads was 4,320,000. This is for a year. The company policy is that overhead will be absorbed on machine hour basis. Since machine hour basis is used for overheads, then the formula to use will be budgeted fixed overheads over budgeted machine hours. So overhead absorption rate, fixed overhead absorption rate, which is budgeted fixed overheads, budgeted fixed overheads over budgeted machine hour. Over budgeted machine hour. So the budgeted fixed overheads is 4,320,000. This is for the whole year. 4,320,000 over budgeted machine hours. Since the fixed overheads is for the whole year, therefore the budgeted machine hours you need must also be for the full year. But if you look at the information given about the hours, you were told the standard machine hour for each product and the monthly budgeted level of production and sales for each product are as follows. You are given on a monthly basis. So, since it is for a monthly basis, you will need to multiply the result by 12. So, what will now be the budgeted machine hours? Budgeted machine hours, budgeted machine hours. We have 10,000, that is for F, times 0.3, 10,000 times 0.3, that is for F, plus 13,000 times 0.6, that is for R, 13,000 times 0.6, that is for R, plus we also have 9,000 times 0.8 for E. 9,000 times 0.8, that is for E. Remember, this will give you the results for a month. Since this information is for monthly basis, so it will only give you the result for 1 month, and we have 12 months in a year. Therefore, the result obtained will need to be multiplied by 12 times 12. 10,000 times 0.3 will be 3,000. Plus 13,000 times 0.6. That gives us 7,800. Plus 9,000 times 0.8. That gives us 7,200. The sum of the three is 18,000. Now for the 12 months in a year, we have times 12. That gives us 216,000 machine hours. 216,000 machine hours. For the whole year, we have 216,000 machine hours. So the denominator here will be 216,000. That is budgeted fees overheads over budgeted machine hours. So 4,320,000 divided by 216,000. That gives us 20 naira per machine hour. We have 20 naira per machine hour. So we now use this rate to absorb fees overheads to each product. Remember, it is machine hourly rate that is to be used, since overheads are absorbed on machine hour basis. We want to absorb the fees overheads. Remember, our overhead absorption rate is 20 naira per machine hour. So for F now, the machine hours, the standard machine hours is 0.3 hours. So we have 0.3 hours times, we've gotten 20 naira per machine hour. 20 times 0.3. That gives us 6 naira as the amount that will be absorbed to F. Therefore, R, the machine hour is 0.6 hour. We have 0.6 hour times 20 naira per machine hour. Remember, our OER calculated fees overhead absorption rate per machine hour is 20 naira. So we have 20 times 0.6. That gives us 12 naira. For E, the standard machine hour is 0.8 hours. You have 0.8 hours times 20 naira per machine hour. So we have 20 times 0.8, that gives us 16 naira. How much is the standard profit? Standard profit. Standard profit for F, we have 200 minus 75 minus 12 minus 6 minus 6 again. So we have 101. 101. Let me reconfirm that. 200 minus 75 minus 12 minus 6 minus 6. We have 101. Then that of R, we have 250 minus 90 minus 15 minus 7.5 minus 12. So we have 125.5. 125.5. That is the standard profit. 300 minus 114 minus 18 minus 9 minus 16. So we have 143. That is the standard profit. 143. Our sales volume variance. Sales volume variance. I've told you sales volume variance equals to budgeted quantity minus actual quantity sold times standard profit. Budgeted quantity, sales volume variance equal to budgeted quantity minus actual quantity sold times standard profit. I've told you under absorption costing, school of thought, that you use standard profit. But in marginal costing, you use standard contribution. 3 products are given. We have F, R, and E. Our budgeted quantity for F, we have, it is given, the budgeted quantity is given on a monthly basis. And if you look at the requirement, calculate the following variances for overall sales for the particular month. That means the variances you have to compute is for a month. So the budgeted quantity for F is given to be 10,000. 10,000. That of R is 13,000 units, while that of E is given to be 9,000 units. Minus actual quantity. And the actual quantity sold for F, 9,500. 9,500 units. Then for R, 13,500. And while that of E is 8,500. Then we now multiply by standard profit that is obtained from our calculation. This is where I got my budgeted quantity. 10,000 for F, 13,000 for R, and 9,000 for E. Then this is our calculated standard profit. For F, 101, for R, 125.5, and for E, 143. Standard profit for F, 101. That of R, we have 125.5. While that of E is 143. So 10,000 minus 9,500, that would be 500. 500 times 101. So we have 50,500. 50,500. So this is the product was sold lesser than planned. Since this is sales, it is revenue. Since the amount sold, the quantity sold is less than planned, then their revenue will reduce. So it is an adverse variance. You have adverse. Here, more quantity were sold. The difference between this is 500. 500 times 125.15. So we have 62,750. 62,750. More were sold, so it is a favorable variance. This one, less was sold. It's an adverse variance. 500 times 143. We have 71,500. 71,500 adverse. What is the total sales volume variance? We have two adverse. Let's first of all add the adverse plus 50,500. Adverse is total 122,000 minus 62,750. So we have 59,250. 59,250 adverse. 59,250 adverse. Therefore, the sales volume variance is 59,250 adverse. Then, Roman figure 3, sales mix variance. If you sum up the sales mix and sales quantity variance, the sum of the two variances will give you the sales volume variance. 3. Sales mix variance. Sales mix variance. Our sales mix variance will be equal to revised budgeted quantity. Revised budgeted quantity minus actual quantity sold multiplied by the standard profit. We need revised budgeted quantity. 3 products are involved. We have F, R, and E. We need revised budgeted quantity minus actual quantity sold. The actual production and sales, that is the actual quantity sold in units, is 9,500, 13,500, and 8,500. 9,500, 13,500, and 8,500. Then multiply by standard profit. From our calculation, we've gotten our standard profit. So our standard profit for F is 101. To go back to our previous calculation. Then 125.5. Then we have 143. So we need revised budgeted quantity. So we want to calculate the revised budgeted quantity. Calculation of revised budgeted quantity. Revised budgeted quantity. Three products are involved: F, R, and E. You are given the budgeted quantity. Monthly budgeted production and sales: 10,000, 13,000, 9,000. 10,000 for F, 13,000 for R, and 9,000 for E. 9,000. What is the total of that? 10,000 plus 13,000, that will be 23,000 plus 9,000. The total is 32,000. 32,000. For F now, you have 10,000 over 32,000 times the total sales, actual sales. Why this will be 13,000 over 32,000 times the total actual sales. This will be 9,000 over 32,000 times the total actual sales. That will give you the revised budgeted quantity. Our actual sales total. Actual sales total. We have 9,500 for F, 13,500 for R, and 8,500 for E. 9,500 plus 13,500 plus 8,500. What is the total? 9,500 plus 13,500 plus 8,500. Our actual sales is totaled 31,500 units. 31,500 units. You now apportion that 31,500, 31,500, 31,500. So let's apportion that 31,500 among the three products using the budgeted quantity. So divided by 32,000 times 10,000. This will be 9,844 units. 9,844 units, or 843.75. Or I just approximate it to nearest whole number. Or let me put 0.75. Then that means this one will be 9,000. It will be 843.75. 9,843.75 for R. We have 12,796 796.875. 875. 12,796.875. For this one, it will be 8,859.375. So, which is 8,859.375. If you subtract 8,500 from that, minus 8,500, you have 359.375 times 143. You have 51,391 naira. 51,391 The revised, the actual is lower here. Actual is lower since it is a sales. So it is an adverse variance. Adverse. This one will be 12,796.875 minus 13,500. That gives us 703.125 times 125.5. That gives us 88,242. 88,242. So this is greater. This is a favorable variance. It's a favorable variance. Then for F, 9,843.75 minus 9,500. We have 343.75 times 101. So we have 34,719. 34,719. This is an adverse variance. An adverse variance. Therefore, if you sum up everything together, 34,719 adverse plus 51,391, 51,391 adverse minus favorable of 88,242. 88,242. Favorable is greater. You have 2,132. 2,132 favorable. Therefore, sales mix variance. Sales mix variance is equal to 2,132 naira favorable. Number 4, you have to calculate sales quantity variance. 4. Sales quantity variance. Sales quantity variance. Our sales quantity variance equals to budgeted quantity minus revised budgeted quantity multiplied by the standard profit. Standard profit. 3 products are given. We have F, R, and E. For F, the budgeted quantity is given to be 13,000 units. For R, the budgeted quantity in question, this information are provided in the question, 30,000 units. And for E, we have 9,000 units. The revised budgeted quantity have been calculated, and we got 9,843.75. 9,843.75. Then 12,796.875. 12,796.875. Then we also have 8,859.375. 8,859.375. Multiplied by the standard profit. From our earlier calculation, we got the standard profit to be 101, 125.5, and 143. 101, 125.5, and 143. These are the standard profits. So if you find the difference between this and this, 10,000 minus 9,843 3.75 times 101. We have 15,781. 15,781 adverse. We have 13,000 minus 12,796.875. We have 203.125 times 125.5. So we have 25,492. 25,492. That is also an adverse variance. Adverse. Then for E, 9,000 minus 8,859.375 times 143. We have 20,109 adverse. 20,109 adverse. So we sum them up. 20,109 plus 25,492 plus 15,781. So we have 61,382. 61,382 adverse. Therefore, sales quantity variance. That is 61,382. Remember, I've told you that the sum of sales mix and sales quantity, I said it will give you the sales volume variance. Let's have the summary. Sales mix variance. Our sales mix variance is, we have 21,000. We have 2,132 favorable. 2,132 favorable. Then we also have sales quantity variance. Sales quantity variance, an adverse variance of 61,382. If you sum up the two variances, this is an adverse variance. Remember, you net them because adverse is greater than favorable. You subtract favorable from adverse. 61,382 minus 2,132. So you have 59,250 adverse. Therefore, this is sales volume variance. Remember, I've told you the sales price, the sales mix and sales quantity variances. I've told you the two variances will give you the sales volume variance. If you confirm, you can see that our sales volume variance is 59,250 adverse. So we shall agree with the result obtained here. In the B part of the question, you have to determine the monthly budgeted profit for the company. Now, let's have B, budgeted income statement. Budgeted income statement. F, then you have R and E. You have the budgeted revenue. You start with budgeted revenue. Budgeted revenue will be budgeted quantity times the standard selling price. So for F, we have 10,000 times 200. 10,000 times 200. 10,000 times 200. That gives us 2 million naira. 2 million naira. Let me keep 3 zeros at the top. Let me add total column. For R, the budgeted quantity is 13,000 and the standard selling price is 250. 13,000 times 250. 13,000 times 250. That gives us, we have 3,250,000. For E, we have 9,000 times 300. 9,000 times 300. That gives us 2.7 million. 2,700,000. Now let's add the three for the three products. 2.7 plus this 5,250,000 plus 2.7. That gives us 7,950,000. Then you less the cost, which include direct materials. Direct materials. So we have 25 times 3, that is for F, times the budgeted quantity, which is 10,000. 25 times 3 times 10,000. 25 times 3 times 10,000. That gives us 75,000. 25 times 3 times 10,000. That is 750,000. 750,000. So that of other products will be calculated the same way. This one will be 30 times 3 times 13,000. 30 times 3 times 13,000. That will give us 1,170,000. 1,170,000 for R. Let me reconfirm that 13,000. This times this is 90. 13,000 times 90. $1,170,000. Then for E, 38 times 3. 38 times 3 times the budgeted quantity, which is 9,000. Now 1,026,000. For the three products now, we have two knife forces. Then we also have direct labor. Direct labor. I will solve this B part in two ways. Let me say this one is method 1. Method 1, direct labor. So which is 1.2 times 10, which is 12. 12 times 10,000. That gives us 120,000, which is, let me show the calculation for that. 1.2 times 10 times 10,000. 1.2 times 10 times 10,000. So that gives us 120,000. Then for R, 1.5 times 10, that is 15. 15 times 13,000. That gives us 195,000. Then for E, we have 1.8 times 10, which is 18. 18 times 9,000. That gives us 162,000. Total for the 3, 162 plus 195 plus 120. Then we have 477. Then we have variable expenses. Variable expenses. For F, 1.2 times 5 times 10,000. 1.2 times 5 times 10,000. 1.2 times 5 times 10,000. That gives us 60,000. For R, 1.5 times 5 times 13,000. 97,500. For E, 1.8 times 5 times 9,000. That gives us 81,000. So total for the threes, 60 plus 97.5 plus 81. We have 238.5. 238.5. So if you subtract that, so you have your contribution, standard, total standard contribution. Or let me say total budgeted contribution, not standard. Total budgeted contribution. Since I've even written budgeted, you don't need total. So just a budgeted contribution. 2,000 minus 750 minus 120 minus 60. Our budgeted contribution for F is 1,070. For R, 3,250 minus 1,170 minus 195 minus 97.5. So we have 1,787.5. For E, 2,700 minus 1,026 minus 162 minus 81. Then we have 1431. 1431. Then the total 9750 minus 2946 minus 477 minus 238.5. So we have 6,089.5. Then from this, you less fixed overheads. Fixed overheads absorbed. These overheads, our overhead absorption rate is 20 naira per machine hour. So, and the machine hour will be 0.3 times 10, that is for F. F, which is 0.3 times 10,000 times 20 naira. 0.3 times 10,000 times 20. So we have 60,000. If you subtract 60,000 from 1,070,000, you'll be left with 1,010,000. That is budgeted profit. $1,010,000. Then for R, 0.6 times 13,000 times fixed overhead absorption rate, which is 20 naira. We have calculated that earlier. So we got 156,156. You subtract it from 1,787.5 minus 156. You'll be left with 1,631,500. For E, 0.8 times 9,000 times overhead absorption rate 20 naira as calculated earlier. So you'll be left with 144,000. If you subtract 144,000 from 1,431,000, so you'll be left with 1,287,000. Then the total fees overhead absorbed, you have 60 plus 156 plus 144. Then you have 360. If you subtract 360 from 6089.5, then you have 5,729.5. Let me make this correction here. My casting of the total column is wrong. 7950 minus 2946 minus 477 minus 238.5. So we have 4288.5. This should be 4288.5 minus 360 minus 360. Then we have 3928.5. So that is method 1. Now, using the second method, let me say method 2. Budgeted income statement. If you like, you can say profit statement. You have 3 products, F, R, and E. F, R, and E. We have the standard selling price, 200, 250, and 300. Standard selling price, 200, 250, 300. From that standard selling price, you deduct variable cost, which include direct materials. For F, 25 times 3, which is 25 kg at 3 naira. That will be 75 naira. For R, 30 kg at 3 naira. 30 kg at 3 naira. That will be 90 naira. And that of E, 38 kg at 3 naira. 38 kg at 3 naira. 38 times 3, that gives us 114 naira. Then we also have direct labor. Direct labor. Direct labor, 1.2 hours at 10 naira for F. 1.2 hours at 10 naira. That will be 12 naira. For R, 1.5 at 10 naira. 1.5 hours at 10 naira. That will be 15 naira. And for E, 1.8 hours at 10 naira. 1.8 hours at 10 naira. That will be 18 naira. Then we also have variable expenses. Variable expenses, which include, we have 1.2 hours at 5 naira. 1.2 hours at 5 naira. 1.2 times 5. That gives us 6 naira. Then we also have 1.5 at 5 naira. 1.5 hours at 5 naira. $7.5. Then we also have 1.8 at 5 naira. That is 9 naira. Then if you subtract all those variable costs, you arrive at standard contribution. Contribution. 200 minus 75 minus 12 minus 6. We have 107. Then 250 minus 90 minus 15 minus 7.5. So we have 137.5. Then we have 300 minus 114 minus 18 minus 9. That gives us 159 naira. Budgeted sales. Budgeted sales quantity. The quantity sold based on budget 10,000, 13,000, and 9,000. 10,000, 13,000. 10,000 is the first one. 13,000 and 19,000. Sorry, 9,000 and 9,000. So budgeted contribution now. Budgeted contribution. 107 times 10,000. That gives us 1,070,000. 1,070,000. 13,000 times 137.5. That is 1,077,500. For E, 159 times 9,000. That gives us 1,431,000. You now less fixed cost. You deduct your fixed cost. Less fixed cost. No, our fixed overhead absorption rate is still 20 naira as calculated earlier. 0.3 times 10,000 times 20. 0.3 times 10,000 times 20 as calculated earlier. 0.3 times 10,000, that is 3,000 times 20. That gives us 60,000. 60,000. If you deduct 60,000 from 1,070,000, you'll be left with 1,010,000. That is the budgeted profit. Budgeted profit. Then for R, 0.6 times 13,000 times 20. That gives us 156,000. 156,000. You subtract 156,000 from 1,787,500. Then you'll be left with 1,631,500. That is the budgeted profit for R. For E, we have 0.8 times 9,000 times 20. That gives us 144,000. You subtract 144,000 from 1,431,000. Then you have 1,287,500. So, what is the total profit? Addition of the three. 1,287,500. 1,287,000 rather, not 500. 1,287,000 plus 1,631,500 plus 1,010,000. The total profit is 3,928,500. 3,928,500. This marked the end of the solution to the question. Please drop the love emoji, like the video, and share it with others. Thanks for watching ZICA.